Okay, well, firstly, thank you everybody for joining this webinar. Just a little bit sort of a housekeeping. If everybody sort of panelists, and unless they're talking, and any participants could mute for the time being. We've got quite a lot to get through, but thank you everybody for joining. Apologies to those who registered before Sunday. When the clocks changed, the technology went mad and gave you the wrong time for this seminar. So hopefully you all got the message and you're joining us now at 2 p.m. rather than 3 p.m. We have a comprehensive list of things to get through. I'm going to kick off talking about the job retention scheme. Then my colleague Richard Maitland is going to deal with the self-employed support. Then Greg Taylor is going to deal with financial support, including the corporate finance funding and the CBILS capital. Then our colleague Lawrence Whitehead is going to cover equity financial options. Alison Horn is going to cover PAY deferrals, and then we'll deal with some wrap up. Questions have been submitted, so thank you everybody for doing that. We will seek to answer those as part of the text as we run through. So if you can hold off asking questions through the Q&A function, because I'm sure it will be covered by the presenters as we go through. But to the extent that it isn't, you can post Q&As, and we will attempt to answer those as part of the webinar as we go through. So they should all be addressed and answered before we close off. And we're not expecting a fire drill, so we won't hopefully have to leave and assemble on our own respective driveways. So thank you everybody, and I'll just start. So starting off with the coronavirus job retention scheme. This is it's worth sort of noting that this is a grant. So this is something that employers will need to sort of pay and reclaim from HMRC. So worth noting that, as there may be some cash flow implications that perhaps my colleagues will cover as we go through the session today, that you need to be mindful of. It relates to all UK employers, so every employer that had a PAYE scheme that was in existence on or before the 28th of February. So all employers will qualify. It will apply to all of their employees. So anybody who was on the payroll, who had amounts that went through the payroll, so employees, and that does include directors, but in relation to the wages that went through payroll as of February 2020, and relates to any of those workers that have been asked to stop working, but therefore being kept on the payroll as furloughed workers. So these are workers that through COVID-19, you would have perhaps formally have had to consider laying off without pay or making redundant. Instead of doing that, retain them on the payroll, and you will then be eligible to claim the grant back from HMRC for up to 80% of their regular pay. You can use this at any time during the period. So this is for an initial 3-month period dating back to the 1st of March. So that will cover March, April and May, and it may well be extended beyond that. But during that initial period, employers can obviously furlough employees. So this new furlough status that doesn't exist in the UK before, but does exist in the States. You can furlough people, and it's about furloughing employees as appropriate. So it doesn't have to all be done at once. It can be phased. But as it becomes apparent that the impact of COVID-19 on your business means that you can no longer fully gainfully employ these people, and therefore would ordinarily need to consider layoff or redundancy, you can furlough them instead, which changes their employment status to that of a furloughed worker. So qualifying businesses include all businesses, charities, recruitment agencies and public authorities. Employees can have any status. They could be full-time, part-time, on agency contracts or on flexible or 0-hour contracts, but they must have been hired before the 28th of February 2020. The employer will therefore be paid a grant. That grant you need to calculate on 80% of the regular wage cost, up to £2,500 a month. You can also, as an employer, reclaim the national insurance on top of that furloughed pay, and the employer's statutory pension contribution, so under auto enrolment, the 3% pension contribution on that furloughed pay. You can pay employees whatever you like. You continue to pay them as if they were still fully gainfully employed, but this is about how much grant you can reclaim as an employer from HMRC, and that, as I say, is capped at 80% of their regular wage costs, up to a maximum of £2,500 per month. For salaried employees, that is their regular basic pay, but excludes any additional fees, commissions or bonuses. They should not be included. For those people who aren't salaried, and therefore where their pay varies quite dramatically throughout the year, it can be based on the same month's earnings from the previous year, so 80% of the same month's earnings from the previous year, capped at £2,500, or their average monthly earnings during the 2019-2020 tax year. So there's some flexibility, but salaried employees, it's based on essentially the February pay, February 2020 pay. But for those people for employees that aren't salaried, the amount of grant that you can reclaim is based on the previous period in the same period in the previous year, or the average over the 2019-20 tax year. If an employee has been employed for less than a year, then it's the average of their pay since they started work. National minimum wage and national living wage does not apply to furloughed pay. So to the extent that you're just paying somebody furloughed pay, you do not have to worry that the 80% calculation might ordinarily take them below what would have been the national minimum wage or the national living wage. If, however, you top up their pay, you need to make sure that the additional amount that you pay them is within the national minimum wage and the national living wage. The amounts are to be paid through payroll, so you operate payroll as normal, and therefore tax and national insurance will be due on all of the pay that goes through payroll, whether that's normal pay or just furloughed pay. It still operates PAYE as normal. You will need to have a UK bank account because the process will be of a repayment to the employer, and that has to go into the employer's UK bank account. Clearly, this is a change to employees' terms and conditions. And so whilst we might consider that this isn't a formal process for the purposes of layoff or redundancy, and therefore a full consultation process may not be appropriate, you do need to communicate with employees and agree with them that you're changing their status from that of full employee to a furloughed employee, and that they're not required or not able to do any work for you during the period that they're furloughed. They need to be furloughed for a minimum of 3 weeks to qualify for the grant. And so that's a full 3 weeks without doing any work for you, without being gainfully employed. If somebody was hired after the 28th of February, then they would not qualify for you to reclaim any furloughed pay. If somebody's on reduced hours or reduced pay, then obviously they won't be eligible for the scheme. So if you instead say, well, I'm not going to furlough you and say that you can't do any work, but I am going to keep you on the books and I'm just going to reduce your hours or reduce what I pay you for, then that won't qualify that for the furloughed grant. Furloughed employees can take part in voluntary work. So that could be voluntary work outside of the business or within the business, and training. So as long as what they do for the company does not provide services to or to generate revenue for the employer, then they can still do things. But the intention is that's to cover their training and that they're up to date with CPD, etc. That's the same as if they undertake online training for you. But for any training courses that they undertake, they should still be paid at least the minimum wage or the living wage, because they are actually doing some work for you. It's not gainfully employed, but they could still be furloughed, but you've just got to pay them the right amount of money. For those on maternity pay, then the standard rules apply. If their maternity leave runs out during the period, during this 3-month period, then the likelihood is you would bring them back as a furloughed employee. and put them onto furlough pay. Similarly, if somebody is off sick, if they're on statutory sick, then obviously they continue to be sick whilst they're statutorily signed off. Once that ends, they could come back onto your payroll as a furloughed employee. The same as if somebody is actually self-isolating, and so it's a voluntary rather than a signed off scenario, they can seek to come back on as a furloughed employee, given that they are away from your work and not working for you during that furloughed period, which, as I say, is a minimum of 3 weeks. HMRC are looking to set up a new system to pay these grants back to you. So you continue to operate PAYE through the payroll system as normal and through real-time information submissions, but HMRC are looking to set up a new portal for you to reclaim the grants. So they're hoping that that they'll be able to pay that before the end of April. So as I say, there's a time lag between the payroll pay that goes through, whether that's March and no doubt pay in April as well, and the time when you can submit your claim and get the money back paid directly into your bank account through this new portal that HMRC is setting up. So there will be a lag. To compensate for that, HMRC are looking for you to be able to make a claim of this grant for a repayment claim of this furloughed pay every 3 weeks. That's easy when we think about the gross pay that we've either put through or are going to put through the payroll. It might be a bit more complicated to work out how much employer's NIC and how much employer's pension you can claim back under the grant, but that's what they're looking to do. Again, this is a very good scheme, but not completely thought through in the circumstances. There will be more guidance to follow, and to make a claim, an employer will need to provide their PAYE reference number, details of the number of employees being furloughed, the claim period, given that it's not necessarily a payroll month, it'll be at least a 3 week period, the amount claimed for this minimum of 3 weeks, the bank account number, contact name, the contact phone number. You will need to do the calculation, and HMRC retain the right to retrospectively audit all aspects of a claim. And I imagine that in the months to come, they will do that, as we've seen that happen with other things in the past. So you need to get this right to avoid them seeking to claim money back from you in the future. You can make a claim for employees that are eligible for the grant, and it will be payment back to you. And you must pay the employee all of the grant you receive. So if you're claiming back £2,500, you must make sure that you put £2,500 through as gross pay to the employee. You can't charge any fees or commissions or anything from any grant that you reclaim and pay on to employees. The one area where there is something of a gap, and I'll leave Richard to deal with the self-employed people, but to the extent that a director is on the payroll and has a very small amount of money go through the payroll, but then has a larger amount paid via dividends, it's just the amounts that go through the payroll that will qualify for furloughed pay for the grant. I don't think there's any mechanism either in this scenario, the JRS, or in the self-employed scheme that says there's an ability to put a claim in for the dividends that are not able to be paid. So that's something to be mindful of. A couple of the questions that I perhaps haven't covered in the general sort of guidance above is, if a furloughed worker cannot work, how does a small business do things such as paying staff salaries, key holders, checking premises, etc.? Can furloughed sales staff come back at any time when the business picks up? Well, as I said, HMRC's view, in order for you to reclaim the grant, is that the worker must be fully furloughed and not doing any work. But there is a definition there of any work that actually generates income for the business. So they can do training, as I said, and we need to think carefully about if you're asking them to come back and do some work that doesn't generate income for the business. That would also be okay, but if they're going to be furloughed, but 1 day a week you're going to ask them to do some work for the business that does generate income or profit, then I'm afraid that won't qualify. You'll disqualify yourself. Clearly, after the first 3 weeks, the expectation is that you could either continue to furlough people or they could come back on the books. That will be fine. It's unlikely in the current scenario that either business will pick up or restrictions will be lifted that would mean that somebody doesn't do at least the first 3 weeks as a furloughed employee. We would hope, things get lifted as soon as possible, but I think it's going to be more than 3 weeks that we're effectively on lockdown, and therefore I can't imagine anybody who's currently furloughed or initially furloughed would do anything less than a 3 week as a furloughed employee. After that point in time, you can bring them back at any time. I would, however, say that once somebody's unfurloughed, it's quite likely, there's no absolute guidance out there, that they would need to be unfurloughed for 3 weeks before you could furlough them again for another 3 weeks. I don't think HMRC are going to look very kindly on furloughing for 3 weeks, bringing them back for a week, then furloughing them for another 3 weeks, and so on and so forth. If staff another question is, if staff have booked holidays, should they still take this holiday whilst on furlough? The short answer is yes, and you would just pay them their furlough pay. I don't think there's any reason why you would alter that. And I think that's the questions that were covered in advance. I know that we've probably got a few more questions, but I'll go through and deal with those sort of online. And so for now, I'll pass over to Richard to deal with the self-employed.
Thank you very much, Nigel, and good afternoon, everyone. This is just to pick up, as Nigel said, on the self-employment income support scheme announced by the government last week as, I suppose, a complementary scheme to the job retention scheme that Nigel just talked about for self-employed people. The guidance, however, on the self-employed scheme is much more limited currently than the JRS, and so my comments this afternoon are based on that limited guidance. What we do know is that the self-employed scheme will be in the form of direct cash grants from HMRC, and they will be for eligible self-employed individuals based on 80% of their average monthly trading profit over the last 3 years, capped out at £2,500 per month. So again, very similar to the figures under the JRS that Nigel was talking about. The grants will be taxable and they will be available initially up until 31st of May. So who's going to be eligible for the self-employed scheme? Well, they must be individuals who are already in self-employment and who have lost trading profits due to the coronavirus outbreak. It does remain to be seen how that loss of profits is going to be tested. Individuals must have been trading in 2019-20 and be intending to trade in 2021. Crucially, there will be a means tested limit of £50,000 of trading profits, below which individuals will need to be below that limit in order to be eligible. That's going to be calculated based on at least their trading profit for 18-19, if that's the only tax return they have, or for, again, those 3 prior years that I mentioned, so 16-17, 17-18, and then that final year, 18-19. It'll be based on 1, 2, or 3 of those returns, depending on how many returns the individual has. But really, really importantly, that 18-19 return must have been submitted for the individual to be eligible. And in order to facilitate late returns beyond the 31 Jan deadline, that has been extended to the 23rd of April 2020. So for those self-employed people for whom this is applicable, really important that you get your return in for 18-19. Also importantly, the scheme does potentially apply to those who have self-employed and employed roles, but more than half of the income during the assessment periods just mentioned must have come from self-employment. Nigel touched on in his comments about personal service companies and the directors, shareholders of those personal service companies. those individuals won't be eligible directly for the self-employed scheme, but they may be eligible, as Nigel said, for the job retention scheme to the extent that they pay themselves a salary under a PAYE scheme, and therefore that potentially is where the JRS would kick in. However, as we understand it, again, stressing that this is based on limited guidance, we do understand that dividend income, payments out of those personal service companies will not be covered either by the self-employed support or by the JRS that Nigel was talking about. So it is just that salary, and I appreciate often it is a relatively low salary that people pay themselves out of PSCs on an employed basis to which the JRS may potentially apply. It is important, though, just to confirm this, the self-employed scheme will cover members of partnerships. So to that extent, we are thinking about members of partnerships, sole traders, and self-employed people in those categories. Because of the need or the wish on the part of government to extend the 1819 tax return filing deadline, the start of the self-employed scheme is expected to be further back than the JRS. So HMRC is hoping to start making these cash grant payments from the beginning of June, but they will be able to be backdated for 3 months to the 1st of March and paid out as a single lump sum. Of course, the next big question is, what if or how do I make these applications for these cash grants? Well, actually, what HMRC have said, again, based on that limited guidance, is that they will be reviewing individuals' tax returns for that assessment period. And HMRC will then invite eligible individuals to apply. And so individuals have been asked not to contact HMRC at this point. Applications are going to be by way of an online form where we anticipate individuals will be asked to verify that they are still trading as self-employed, and maybe also verify that they have actually lost trading profits as a result of the outbreak. Once, however, grants have been deemed to be eligible and payable, then that cash will make its way directly into individuals' bank accounts. Individuals who are not eligible for the self-employed scheme may be able to access some of the other forms of support which the government has announced, some of which we'll cover later on in this presentation, or, for example, universal credit. It may be that individuals who will ultimately be eligible may be also able to claim for that support during the period before the self-employed scheme is up and running. It's also worth mentioning at this point that, I suppose, as further support to self-employed people, that self-assessment income tax payments, so the second payment on account for 1920, which was due on the 31st of July 2020, is also being deferred, and that new deferral date is the 31st of January 2021. So as I said, that is a summary of the current guidance that we have on the self-employed scheme. The guidance is much more limited at the moment than we have for the JRS, and obviously we'll be using updates through our website and through webinars like this to update you further as more details emerge.
Thank you, Richard. That's great, and obviously there'll be some questions on the Q&A. If I can hand over now to Greg Taylor to deal with funding.
Brilliant. Thank you, Nigel. Good afternoon, everybody. So we're going to cover a couple of bits on the section. So we're going to cover the SME scheme that the government have launched for support, and we're also going to cover the larger, medium and corporate size scheme, the CCFF. So starting with the Corona Business Interruption Loans scheme, or CBILS, that scheme is designed to support long-term viable businesses who may need to respond to the cash flow pressure because of the COVID-19 outbreak. The loan is provided by the British Business Bank, but it is accessed by participating providers, of which there are 40 plus providers, and is open for an initial period of 6 months. It is open to businesses with a maximum turnover of 45 million, and that has been increased from the scheme that it replaced, the EFG, the Enterprise Finance Guarantee Scheme, which had a limit of 41 million. Types of facility that are available under CBILS. So it applies to term facilities, so loans, overdrafts. You can use CBILS to procure an overdraft, invoice finance facilities, and asset finance facilities as well. Key aspects of the scheme. So maximum loan is £5 million. The repayment terms on that will be up to 6 years. Some of them, like invoice finance, for example, the maximum term is 3 years. 80% guarantee from the government, but it's worth noting that the borrower remains 100% liable for the loan. There's no guarantee fee for SMEs to access the scheme, which usually there was a 2% fee on the EFG. That has been covered by the government, and the government are also covering the interest for 12 months. We've also seen some of the banks offering capital repayment holidays as well, just out of interest. Finance terms, as I said, up to 6 years. For loans and asset finance, overdrafts and invoice finance facilities, terms will be up to 3 years. Security. This is an interesting question and something that's been knocked about quite a bit in the media. You would have seen towards the end of last week. So currently the situation is that the 4 main high street banks all got together on Friday and had a conversation on the phone apparently. And the current guidance is that up to £250,000, no security will be provided or need to be provided, so no personal guarantees, etc., from the borrower. Above that level, the security is at the discretion of the lender, and various lenders are putting in various different, they have the ability to be able to assess an application and request security as they deem fit to fit the level of risk, etc., within there. So, for example, we've seen with one bank, they've got 3 levels of loans, so up to 250, no security. Above 250 to £1 million, short form guarantee plus a debenture, and above that level, so above £1 million funding, they would then also request tangible security. So the maximum loan size, as we've discussed, is 5 million, but within the scheme, it's limited also by either 25% of the company's 2019 turnover or double the annual wage bill, whichever is greater. And again, for clarity, the borrower always remains 100% liable. So in the event that you cannot repay the loan, the bank or the financial institution is obliged to try and recover the monies, 100% of the monies from the borrower. If they cannot do so, then the bank will be able to rely on the guarantee from the government up to a maximum cap. Each lender is capped as to how much they can claim back across the board. Eligibility. There's a couple of bits on the British Bank website, British Business Bank website, which gives some outlines around eligibility. So the 5 things that they say are the core eligibility is your application must be for business purposes. You must be a UK-based SME, as we discussed, with an annual turnover of up to 45 million. Your business must generate more than 50% of its turnover from trading activity. The CBILS-backed facility will be used to support primarily trading in the UK. So our understanding is if you have more than 50% of your trading outside of the UK, i.e. in an entity outside of the UK that then funnels back in under consolidated accounts to form your turnover, you wouldn't qualify. And you wish to borrow a maximum of £5 million. Those are the main criteria. There are other industry types, etc., which don't qualify. They're a very small list, and there are other eligibility criteria which you can find on the British Business Bank website. How do you access the scheme? In the first instance, you should access the scheme by your own provider. So the high street banks, if you have an asset finance facility with someone like Haydock, for example, you can approach them. It's worth saying at this point that MHA McIntyre can support you with this. We've had some very good experiences with supporting clients through the process. We've spoken to all of the high street banks and understand the information that each one of them is looking for. As I said, each one of them is slightly different in what they're asking for than the years of accounts that they request. Some want 2 years year-end accounts, some want 3. And there's lots of questions around COVID-19. How has it affected the business? How will you repay the loan? Is the business a viable business is a really hot topic of a question at the moment. And how do you prove that viability? and we have been able to do that with our colleagues in corporate finance to support you through that process. The banks are very busy, as you can imagine. Lots of people applying for these loans, and if you don't have all the information ready, you've not got it together, they will put it to the bottom of the pile and they will go to one that they can deal with that has got all the information, or they know that they can put through. It's also worth saying, because again, there is some discrepancy around understanding how the loan has been set up, which is around that the bank doesn't have to offer you a CBILS loan. You can apply for it, but in the first instance, they are obliged to see if they can offer you normal commercial funding. If they can offer you a normal commercial loan, that has to be the first port of call. And if you reject it, that doesn't mean that you can then get a CBILS loan. In terms of the information that needs to be provided, this is the kind of a shortened pack of information that we've seen that most banks are requesting. So 6 months bank statements, obtain your last 2 years at least year-end accounts, full year-end accounts, prepare up-to-date management figures, 12 months forecasts with a cash flow. Cash flow is absolutely key about how you're going to repay this loan. What other options have you explored? The banks are requesting that you've explored all the other options. So, you know, the furlough, have you looked at putting rates back, all the other bits and pieces. You have to have looked at all the options, VAT, deferment, all the other options. How will you repay the loan? It's where the projections come in, and then put together a piece like a mini business plan on the management and the sector that your business works in. Don't assume your bank understands your business and understands who the management team are. They don't. And also consider what other options there might be out there. A lot of talk about, I need to get a CBILS loan. You know, there are other options out there. There are other lenders in the alternative market, in invoice finance, in asset finance, other term lenders that can plug that gap if you get turned down for a CBILS loan. So that covers the CBILS part. If we move on, and I can answer any questions at the end around the CCFF, which is for larger businesses above 45 million in turnover. So that is the COVID-19 Corporate Financing Facility, or CCFF, and it has been put together for large and medium-sized UK businesses to facilitate, put my teeth back in, credit supply and maintain liquidity. It is more of a short-term option than the CBILS scheme. Maturity is generally between 1 week to 12 months, minimum loan of 1 million, and then there is a step going up of 100,000 at a time, and it is decided, the cap for that loan is decided by the Bank of England risk staff on a case-by-case basis. Commercial paper will be purchased at a spread of above reference rate, meaning it'll be interest bearing. You do have to pay it back, and debt is issued directly into Euroclear or Clearstream settlement houses. Whilst commercial paper will be unsecured, parent company guarantees in a form acceptable to the Bank of England may be required. Eligibility, again, this is another, as exactly with the CBILS scheme, the eligibility is a really hot topic. Both schemes, interestingly, are open to all forms of companies. So limited companies, LLPs, limited liability partnerships, sole traders, partnerships, any of those entities can apply. Freelancers, any of them can apply for all those loans, providing you've got the required information. In terms of the CCFF, it's fundamentally targeted at strong businesses that are experiencing severe disruption to cash flows and can demonstrate sound financial health prior to the COVID-19 pandemic. The clearest way that the Bank of England deems to demonstrate that is by having an investment grade short-term rating, and there are various ratings from one of the following: Standard & Poor's, Moody's, Fitch, and some other ones as well. I think there's been a lot of talk about this, and it also says in the small print that if you don't have one of those, you still may be eligible. Again, access is by your bank in the first instance, and again, you know, via our corporate finance team, particularly on this one, but by myself as well, we can give you some help and some guidance and support in applying for those if required. I think that just about covers what we need to say on that one. And I'll hand over to my colleague Lawrence, who will cover off some other options around equity.
Thanks, Greg. Yeah, I'd like to spend thinking about if you're considering raising equity finance either alongside or in addition to debt. First factor to consider is cost. Equity investors are very much at the bottom of the creditors list if a business runs into difficulty. So they will expect a higher return for the higher unsecured risk that they're taking. Over the life of the investment, this return can be anything between 2.5 to 3 times their initial investment, which can equate to between 20 and 30% return per annum. But clearly that is much higher than the cost of secured debt, but it equates and reflects the risk that equity investors take. Another factor to consider is the current gearing level of your business. If existing financial covenants that are in place may restrict the raising of more debt, so equity may be the only route available to you. And obviously Greg touched on a moment ago that there are other options to the CBILS and the CCFF facility. A growth profile. Need to be thinking about this in some depth. If your business has higher growth prospects, then it will be far more attractive to equity investors, as these sorts of businesses offer the best chance of the high returns required by equity investors that was mentioned a few moments ago. Future exit options is a major consideration as well for equity investors. They ultimately want to realise their investments, so the needs at the outset to be in alignment of thinking with existing shareholders on exit strategy and timings. The duration of the funding needs to be considered. Equity is generally a longer-term funding source than debt, and it may therefore actually suit some business owners who have longer-term growth and investment plans for their business when compared to shorter-term debt solutions. Asset profile also needs to be factored in. Businesses with less robust tangible asset bases lend themselves far more to raising equity than debt. And similarly, businesses with lumpy or less predictable cash flows also lend themselves more towards looking to raise equity than debt. Repayment flexibility is important. Equity-related payments are invariably more flexible than debt. For example, if absolutely necessary, dividends can be withheld from shareholders, but interest and capital on debt invariably can't without breaching financial covenants. Also, operational and strategic support that may be available. Some owners welcome the expertise that an external, highly experienced equity investor can bring to their business over and above the funding that they put in. Another factor, control. Equity investors will want to protect their investment, and they do this generally by the use of mechanisms such as enhanced voting rights, ratchets, drag and tag-along provisions, and other high-level operational restrictions. So if current owners do want to retain full control of their business, then equity will not be the right route for them to take. And final consideration is speed of receipt. This depends on the reasons really for raising the finance in the first place, and also depends on the financial position of the businesses. Society will determine a business's attractiveness to providers and hence the speed at which access to funding is made available. So they're the key factors and considerations. If you do decide equity is the right route to take, then what you will need is an investment document. This document sells the business to investors with positive messages, laying out realistic plans and objectives. The key things that you'd need to include in a document such as this is the history and the background of the business, things like products and services and where appropriate production methods in the business, the market and the demand for the services and or the products both now and in the future. Also an analysis of your key competitors and your key suppliers, a realistic and sensible assessment of sector barriers to entry, a marketing plan to achieve identified for growth, intellectual property rights These are critical to achieving the plan that's laid out in the document. An organisation structure, details of facilities and premises, and ability to expand and grow those facilities. Also covering off any risks. Don't avoid talking about them, but outline ways that you can minimise them, so you show that you're clear what the risks are in the business, but also that you've thought through how you can deal with them. Financial projections, similar to raising debt, P&L, balance sheet, cash flows. Also, analysis of the amount that you require and the proposed use of those funds is absolutely key. And as mentioned, the exit options and the timescales for that to make sure that you're aligned with the investor. Finally, don't be afraid to ask equity investors what they can offer your business over and above the funding. So in that way, you can assess the chemistry and the likelihood of being able to work together for at least several years and possibly even longer. So some of the things that you should be asking is what sort of strategic and operational support can they give, and the costs that are attached to that. What access do investors have to a wider network of contacts in existing and or target markets that you're aiming to get into? Access to MBI candidates to supplement the incumbent management team, if that's an important factor. Also access to other portfolio companies that they have, so that you can tap into sales opportunities and also share best practices with those companies. Further funding for M&A and other growth requirements, such as working capital or new premises. What ability do they have to support that? And again, the exit horizons and options available to that. Due diligence and document once a deal is agreed with the preferred investor. Suffice to say, I'm very happy to talk offline with any parties interested in discussing this further, as we all are. Thanks for your time. I'm now going to hand over to Alison, who's our senior VAT partner. Thanks for listening.
Thanks, Lawrence. Hello, everybody. So the VAT automatic deferral was really good news, but there are some details I wanted to talk to you about. First of all, who does it apply to? Well, it applies to any UK VAT registration. So that now includes overseas businesses that are registered in the UK, and also charities and not-for-profit organisations. So that's really good news. It's automatic, so you don't need to go to HMRC to get approval to do it now. It covers the February, VAT return periods ending February, March and April. If you're on a direct debit to pay those VAT returns, then please make sure that you cancel that direct debit, because otherwise if you submit the return, HMRC will automatically take that payment from you. For large businesses who are on payments on account, it covers any payment on account that you're going to make by the 30th of June. So again, make sure you cancel your direct debits so they don't get automatically taken, because they're already on a schedule. So that's an important point. I've had some questions, and probably the most popular question I've got at the moment is, I can't get into the office, I can't actually put my return together. Can I wrap it up in the next return? Do I just not submit it? What should I do? As Greg was saying, and Lawrence, for finance, it's really, really important that you get this VAT automatic deferral. To get that, you need to submit a VAT return. So I would really urge everybody to submit those VAT returns. What happens if you don't submit the VAT return is that you'll get an automatic central assessment from HMRC, probably about 2 weeks after that return was due. If you just pay that central assessment, then you're then starting to play within the penalty regime. So I really would recommend that you submit that return and take the benefit of the automatic deferral. If you absolutely cannot get to your records to produce the return, you can go to HMRC and ask them for permission to have an estimated VAT return. You're supposed to get permission for this, but we do expect this to be relaxed in the next few weeks, where you should at least be telling them that this is what you're planning to do. If you do an estimated return, you have to estimate both the sales and the purchases, and then you do the correction on your next VAT return. little bit on PAYE deferrals. My own experience on this, I phoned the COVID helpline. A lot of people say, oh, it's impossible to get through, but do persevere. I did get through after about an hour. I did then find that I was talking about pay-as-you-earn and VAT together. And if you have a liability that is over £150,000, they won't deal with it. You'll be referred to the large debt unit. We found that once we spoke to them, and it's very important to speak to HMRC before the due date of that submission, they were very happy to do an automatic deferral for 3 months. So for pay as you earn, you really must get in, speak to them before that payment is due, and they will only do it on a month-by-month basis. So it is not caught by the same automatic deferral as VAT is caught by. One final point for people who are importing: if you have a duty deferment account, you may be worried about, well, can I cover this under the VAT automatic deferral? Unfortunately, you can't, but customs have been helpful in also agreeing time to pay, but you do need to contact them, and they're only looking at it on a month-by-month basis. We expect some more information on that soon. I think that's everything on the VAT, so I'll hand back to Nigel now. Thank you.
Thank you, Alison, and thanks to all our presenters, and thanks to everybody who've been sending in questions. I just wanted to answer one or two, and thank you to Rachel, who's raised a few questions. As is usual, you think you've said something, and then maybe you've said something else. So just wanted to sort of clarify on the JRS scheme. The grant obviously is intended to be something that you claim back but obviously you can't run completely a coach and horses through employment law. So annual leave, to the extent that you pay that to somebody whilst they're furloughed, is based on their normal entitlement to paid annual leave. That might be different from what you can claim back under the furlough grant, but you must pay them their proper annual leave pay. Somebody can be made redundant whilst they're furloughed, but obviously you need to look at what happens with the timing of that, and obviously the calculation of their redundancy pay needs to be carefully considered, as obviously it wouldn't be appropriate for their redundancy pay to be based on their furloughed pay. So you need to look at that and the timeframes that are required if you were to make somebody redundant whilst they are being furloughed. Statutory sick pay follows the normal rules. So to the extent that somebody is already sick, then obviously you can continue to pay them, and they continue to be entitled to SSP. Once they are no longer sick, then obviously they would seek to be returned as a furloughed worker. If somebody's furloughed and they go off sick, then there's no criteria at the moment that suggests that you need to adjust what you pay them or what you claim back in relation to furloughed pay. So that might be more advantageous to continue to pay them and claim furloughed pay. Because if somebody's furloughed and they're no longer working and they're not asking them to do any work for the business, how we would know their status in terms of sick pay and coronavirus is not clear at all. And then just to make absolutely clear that the criteria for the grant is open to all businesses. So somebody in construction has sort of asked the question, because a site might not just close down completely, or business might not close down completely. It's around the qualifying criteria for a furloughed worker is where you don't have the work for them anymore as a consequence of COVID. So you may well have different sites that close at different points in time. So therefore you may phase furloughing employees. You haven't got to close your business entirely, absolutely not. Nobody's got to look to do that. But you still qualify, obviously, on a flexible basis in relation to furloughing employees and claiming the grant back. So hopefully that's answered and clarified. So again, thank you, Rachel, for pointing out that I may not have said what I meant. Some of the points that we covered. Can I say that there will be a full recording of this coming out in the next day or two. It takes a little bit of time to download, but it will definitely be downloaded and sent out to attendees. And also there'll be a link to our COVID-19 update site, and also a place where, as before this conference, this webinar, you're able to submit questions. So to the extent there are questions that have been submitted that we haven't answered, then obviously we'll seek to answer those after the event by email, or you could email in with any questions directly. But for the time being, I thank everybody for attending the webinar. Thank you to the panelists for presenting. There's certainly a lot of information there. There is a lot of support available from the government and from associated parties. There is a real desire for everybody to sort of manage through as best we can in these unprecedented times. But there will undoubtedly be questions and queries and idiosyncrasies, and even some gaps where the support doesn't meet or manage people's expectations. But hopefully that's been very helpful for everybody, and thank you all for attending.